What should a reverse mortgage borrower do when they're facing a potential default and foreclosure on their home? Well, it's definitely not what one Detroit area homeowner is being accused of. Yes, the owner of an extravagant home actually is being, held in jail. That is the Wayne County Jail, being accused of second-degree arson. So let's get into this story a little bit. A 75-year-old Detroit man gained national attention years ago for listing his home online that really looked like Liberace's mansion. I mean, just look at this. It is crazy. Just the decoration. This guy, by the way, was a car designer. He created beautiful custom cars for even Saudi princes. So he had quite the reputation in the past. And so he became very well known for just the extravagant improvements to his home just outside of Detroit. But this gentleman, getting back to the original story, has been accused. Ronald Nasser has been charged with second-degree arson in the June 16th fire at his home on 450 West Grexdale, also known as the Liongate Estate. And so when the firefighters arrived on scene, they found him standing outside of the home uninjured, but later he was arrested. So Mr. Ronnie, as he's known, did appear in district court wearing handcuffs and a dark green jail jumpsuit, and his preliminary examination of the case was bound over to the circuit court. And his attorney said that he would request a mental competency evaluation. So you can see the gentleman there on the far right. So how did this all start? What led to this potential eviction? Well, they did a little digging at the Detroit Free Press, and they found that Nasser was facing eviction after he defaulted on his reverse mortgage. And the home was actually sold at a sheriff's foreclosure auction last year. So here's what the defendant's attorney has to say. He says, "I just wish people would stop scamming senior citizens. Leave them alone," said attorney Larry Polk. "Stop promising them things they know they cannot and will not be able to provide for them. They should be ashamed of themselves." Well, which is quite interesting is that this is a default, just like any other mortgage. And what Mr. Polk, the attorney, fails to mention is that, well, this is a violation of the terms of the loan. And any attorney worth their salt knows this, of course. So let's look where this all began. It says that in 2015, property records show that Nasser took out nearly $300,000 in a reverse mortgage. That number actually gets a little bit confusing later on, but they do note, the Free Press rightly says, that the property owners still must be responsible for paying their property taxes and homeowners insurance. But Nasser was struggling to pay the latter, according to a carpenter that worked on his home. So not paying those homeowners insurance premiums led to an issue in the spring of 2024 when he was declared to be in default on the reverse mortgage and owed about $189,000 at that time. That triggered a foreclosure and the mortgage company's subsequent purchase of the property and auction. Then on June 4th, the company Mortgage Asset Management, who does business as Reverse Mortgage Solutions, began the eviction process in a district court hearing, but the company didn't respond to the Free Press for a request for comment, which is pretty typical in legal cases like this. The Free Press notes that Nasser was served an eviction notice on June 12th and failed to appear for that hearing, which was scheduled for June 16th, which, well, consequently happens to be the same day that the home was set ablaze. I just find it actually quite weak yet funny that Mr. Nasser's attorney is blaming the reverse mortgage loan, saying it was a scam, when in fact this attorney, who knows contract law, understands that this is a violation of the loan's terms to not keep property taxes current and also a homeowner's insurance policy in force. But we will keep you up to date on this story as it develops. The next court date for Mr. Nasser is on July 14th, so we'll let you know if we hear anything. Home sales are now frozen in what is the home equity conversion mortgage's largest market. Of course, I'm speaking of the state of California. But the Golden State has seen a reduction of 37% in home sales from the pandemic peak, and now we're at levels that are just a little bit shy of the lows that we saw in the Great Recession and economic crisis of 2008 and 9, and those levels went all the way through 2012. So let's dive in and see what Newsweek has to say. First, it says that real estate analyst Nick Gurley, Reventure CEO and founder, and by the way, he has a very interesting YouTube channel if you want to check out Reventure. He says that this is really a massive home buyer strike that we're seeing in California. And in other words, would-be home buyers are just standing on the sidelines saying, you know what, I'm done. I'm not going to pay a ridiculous price at these interest rates that we have today. And that is likely the result of just the median price in the state of California being one of the highest in the nation. While home buying does appear to be frozen in the state of California, looking at some of the forces that we're seeing, one is that homes are staying on the market for longer. So in the Golden State in California, they're on market for an average of 31 days before they go under contract. Now, that's slightly better than the 38 days for the national average, which both of those are actually elevated numbers. According to the latest data from Redfin, home sales in California totaled just less than 25,000 in the month of May, and that's down nearly 8% from where it was just a year before. And an analysis of historical data by Reventure noticed that number was about 25% less than the state's long-term average. That is the typical or expected number of sales over an extended period of time. So we can say that this market is somewhat frozen. It's also significantly less than the pandemic peak, which we saw in June of 2021, when we had 43,000 plus sales transactions completed. This was also significantly lower than the pandemic peak we saw in home sales in June. So a real depression in home sales in the state of California will naturally lead to increased pressure on sales prices and also home values when they're appraised. And that is the concern that we have for reverse mortgage borrowers, because if prices flatten, which most of them have in California, or worse, begin to slip significantly, this, of course, would mean less proceeds for future reverse mortgage borrowers, whether it's the HECM or a proprietary loan, especially for those that were looking to tap into what they thought was a really big cushion of home equity. So as we see increases in home inventory, then that's also going to apply pressure to home values. Naturally, supply and demand. And here's another interesting tidbit. According to Realtor.com data, active listings in California totaled 76,737 in the month of June. That is the second highest inventory level for the month of June, going back nearly 10 years, notes Nick Gurley. And the question is, will inventory continue to increase in the Golden State? And if it does, then there is a strong potential for California to experience a 15% correction in home prices. Another thing that we're seeing in the state of California and in many parts of the country are price cuts. So the home sellers are realizing this home's not selling, it's staying on the market or the multiple listing system for too long, and they're being forced to cut down prices as well. So as we see this increase in inventory and then also downward pressure on home values, you really want to be reaching out to potential reverse mortgage borrowers, because as you know, they may qualify today, but they may not qualify in a month or two or next year if home values do slip in the Golden State. No tax on Social Security benefits. We know this was one of President Trump's campaign promises, a promise that he intended to keep by including this provision in what many call the Big Beautiful Bill. However, legislation is subject to changes, markups, and amendments, and that was the case when the U.S. Senate invoked what is called the Byrd Rule. That is a procedural Senate reconciliation constraint which prohibits any provisions in a reconciliation bill that will impact Social Security's funding or structure. And because of that, the full repeal of any federal taxation of Social Security benefits was simply not a possibility. So instead, there is a new plan in place. And just looking at this recent column in NPR, it says in the hours after Congress passed President Trump's mega bill. An email from the Social Security Administration hit the inboxes, of many Americans, and it applauded the legislation's passage. And it falsely said it included a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries. Well, that is not the case because that is prohibited by the Byrd Rule on any reconciliation bill. So what we have instead is an additional deduction on top of one's standard deduction, whether you're filing as a single filer or married filing jointly. So Social Security benefits are still going to be taxed, and how it presently works and how it will work in the future is that 50% of Social Security benefits are taxable for a single filer who earns more than $25,000 in combined income. And then 85% of Social Security benefits become taxable for single filers that have more than $34,000 in combined income. For those that are married filing jointly, if they earn more than $32,000 in combined income, then 50% of their Social Security can be taxed or would be taxed. And then up to 85% of a married filing jointly filers would see their Social Security taxed, at least 85% of it, if their combined income exceeded $44,000. By the way, those are really low income thresholds. So what happened is that the big beautiful bill instead is providing a bonus of sorts for seniors over the age of 65. And I'm just going to summarize this real briefly for you so you can understand some of the financial pressures and also benefits that the homeowners you meet with are facing today. So in short, what this will do is for any taxpayer who's 65 and older, they're going to get a $6,000 deduction on top of their standard deduction and an additional $12,000 deduction for married couples filing jointly if they're both over the age of 65. But this deduction phases out where anyone that has a modified adjusted gross income of $75,000 or more for a single filer or $150,000 for married filing jointly. And then for any household that has over $250,000 in combined income for joint filers, it completely phases out. So this deduction applies to all income, not just Social Security. So, and in reality, this may actually lead to many more older households and seniors having to pay no federal income taxes in years maybe where they have been paying in the past. But this senior bonus, so to speak, this additional tax deduction is temporary. It's limited to the tax years 2025 through 2028 unless it's extended until a later date. So in short, this bill does not change any of the rules on Social Security, and Social Security benefits are still going to be taxable for many senior households. But instead, what we're seeing is the indirect effect of an additional deduction that may lead many seniors who have paid federal taxes in the past to have no taxes due at all, and that could be a boon for many households that are cash flow constrained in their retirement years.